Warriors. How's everyone doing today? Good morning, Patrick. Kurt, nice to meet you. Dan, great to see you back in the saddle. How's everyone doing today? So, don't you love it when a plan comes together? So, you guys know I pay a lot of attention to the Russell. It was the first one to display weakness and divergence before the panic earlier in the month. And I was looking for a back test of the wedge here at 156, and it was close enough for government work. Put in a nice outside day, on the verge actually of an outside week. If we take out 152, I want to tip my hat to Steve Volge, first of all, for being patient to wait for the rally up towards 2,800 that we didn't quite achieve, you know, he caught the first wave down on the first panic and then was patient enough to wait for the rally up here. The high was 88. So live, he said he was in, I don't know, I think a little bit more than half. I don't know what he did when it started to fail. We'll find out, but potential reversal week in the S&P. We'll see if Powell tries to calm things down. In fact, Blake and I were talking about that. Powell could act like a tough guy with the S&P up above 2,700, approaching 2,800, and that's exactly what he did. He sounded pretty hawkish, and we had air come out of every market. Dollar surged. In fact, yesterday we talked about a bull flag in the dollar before it broke out. I think it showed up better on the 4-hour. Here it was. So before the breakout, before Powell, we said, you know, do not be short the dollar. I'm still, you know, I won't chase the dollar now, and I'm not going to fade the dollar now. So every once in a while, you know, if you're not long, I'd stay long. And also, after windfall profits, you have to take something off the table. But then you reach a level in the market where, you know, you may want to wait for a pullback to get on board, or wait, or look for, you know, I thought we could go to 91, 91.50 before this is over. Maybe we're there. The dollar is going to rally into the Fed meeting, into the hike, and it'll be kind of like buy the rumor, sell the fact in the dollar. But I'm not going to short it here. Everyone understand that sometimes a market, you don't want to chase it, but just because you miss the long side is certainly not a reason to reverse or say, well, I missed the long side, I'm going to short it because it's overdone. How do I know that? How do I know that thinking? Because I've witnessed thousands of traders in my career, and those thoughts have rattled around in my brain and even caused me some pain. You know, you miss something, so you say, well, it's overdone, I'm going to go the other way. I wouldn't go the other way. One of the markets that showed after the slaughter some resilience, although I don't believe we're quite there yet, were the precious metals, because we had a little bit of a tail. Still is not a bottom to me. Look at this RSI reading down here. You cannot, you got to look for new lows. This is a confirmed low. Maybe one more low might do it if we stay above 30, but I see no reason to buy gold. And this still looks like it might be corrective. We could rally 1325 first, but this is not a low to me. But, you know, as you guys know, I also trade ETFs, and just want to give you a quick view of what happened yesterday. This is a bearish bank ETF, which put in a higher low as well, kind of filled the gap from back here. One of the, a much deeper pullback than TZA, which is the bearish Russell 3 times. Very nice looking day. If the stock rout continues into next week, there's still some upside. NASDAQ this is the NASDAQ bearish ETF, has been the weakest. It actually made a new low. But low bear market rally here in this. The leader still seems to be, of these ETFs that I trade, the TZA, the Russell. So, you know, my view on the Russell, you know, my fantasy for this would be that this is a failing rally and we're going to take out the lows. But, you know, there's still a lot of people looking for new all-time highs into March, April. So this could turn into, you know, a break to buy, maybe down here. But when I look at the daily, I think there's potential for us to at least do this. And this would apply to all the indices, have equality, which would take it to new lows, maybe around 140. And you know what? No one's talking about it. Everyone's just looking for equality. No, not many looking for a fib extension of this initial panic that we had in February. But you know, my fantasy on this is that we're going to break all the way back down towards these August lows, 132, 127. We'll see. But this is an example of planning your trade before it gets there. I actually tweeted out a short there. And you know what? Hats off to Blake Morrill. No one in face, nobody, should have been long the euro since this day. Blake's been hammering and trying to bring the point home. False breakout to the upside means a potential breakdown. We're at major support here. So this is why I want, you know, actually chased alongside the dollar, the short side of euro. You know, maybe we're going to try and dig in our heels and rally again. And, you know, you only have 2 drives. So if the dollar starts to weaken, which it could because of what's happening in EG, EG's having a very good day. I still have a bullish bias in EG. You know, I said to get out last week when I saw it heading down, but you know, the breaks are getting shallower and shallower, and the cable's now much weaker than euro. So maybe one of these days, EG is going to break out. My bias, and that's all it is a bias to the upside, because I'm looking for this dollar rally to fail, maybe up around 91.5, and that we could get one more shot down. Have a great guest today with us, and his name is Andrew Thrasher, and he won the Dow Jones Award for his work on volatility. So I'm really looking forward to speaking with Andrew. He has a CMT designation, Chartered Market Technician. It's not an easy certification to get, so stick around for that interview. And everyone with me on what I'm thinking here?
You know, Dale, I'm going to tell you what I'm thinking.
Okay.
Your ideas of a fantasy is so much different than mine. You dream about ETFs, and I dream about like bonds and, you know, parties, and you know, it's like you have weird fantasies, man.
Well, you're a couple years younger than me.
I would think as I got older, my fantasies got a little bit more extravagant, a little wilder. But you dream about like ETFs and stuff.
Yeah.
You know, what kind of weirdo are you? Yeah.
Yeah, I am. You know, I'm not going to, you know, debate it.
Weird fantasy.
The Yiddish word for what kind of person I am, it's called a mashugana, which is kind of like a crazy person. So good observation on your point, on your part, Blake. Yeah.
Anyway, jokes aside.
Anyway, I had a great month yesterday.
Awesome.
So you know what that's like, right?
Yeah, actually, I've had a really good month, and I'm trying to keep it kind of quiet going into month end. This is month end, and
Right.
I've got just a little bit of dollar longs left, but you know,
you really prepared everyone. I don't think there's anyone in our large free webinar that, you know, was along the long the euro or cable or, or bearish the dollar for the last 2 weeks because of your analysis and Steve's analysis. And God, I think all three of us talked about the bull flag before it broke out yesterday, Blake. So, we're keeping people, at least if they're not going with us, hopefully they're not fading it and getting hurt. So,
or just even a little bit more defensive. Look, I never claim to be the best trader in the world.
You're one of them.
Well, I mean, I had one of my best days of the year yesterday, so it was a great day, and it's been a great month actually. And but hey, just so you guys know, it's not all roses and everything. I traded the pound dollar and I lost money yesterday, although I put out a pattern in play for a short, which is working exactly as I thought. I traded it horribly yesterday. I actually lost money trading the cable. I sold it at 139.15, and I think I got out at 139.30, and now it's trading at 138.20. I mean, what kind of crap is that? I mean, I knew it was going down, and I got wiggled out during the dollar pullback yesterday. Fortunately I stayed with the euros and everything, but still, it's, I mean, I'll give myself credit for one thing that think I've been really good at for the last 15 years with traders on these webinars, whether it's been here or it's been when I was with the Wise Trade group and you guys listen in there. I am pretty proficient in seeing the turn and being able to see the moves or the forest behind the trees, which not everybody can really see. And that's I definitely get sideswiped in the markets from time to time, but I've got a pretty good judgment for the longer term trends, or if they're turning. And that's one thing I will give myself credit for. And it doesn't mean that I'm always going to trade it correctly either. So don't think that just because it's easy making a call, it's not easy. It's not always as easy trading a call. And that's something that everybody should be aware of. There are a lot of analysts that it doesn't translate into traders. So, and that's I've seen it myself.
Yeah, I concur with that 100%. When there's money on the line, in fact, I saw a tweet the other day that some people in a demo account could make $1 million in their demo and then put real money on the line, and they blow up.
I've seen it 1,000 times, thousands of times. I mean, it's not that's for sure. And I'll tell you, I've met analysts that can't trade themselves out of a paper bag, a wet paper bag at that. So, but they're really good at analyzing the market. As you guys know, at least most of you may know, I trade for Gellows Capital. I also, I'm also the founder of ForexAnalytix. I obviously have to put my money where my mouth is. And and everybody that's in our chat room knows pretty much what I'm doing and how I'm trading. And sometimes I'm having good days and sometimes I'm having bad days. But everybody in our private chat that's with ForexAnalytix has an awareness of hey, I trade just like everybody else. I will have good trades and I will have bad trades, but like I said, from an analysis standpoint, I do give myself credit that I'm fairly good at seeing most of the bigger moves develop, and I miss some too. It's not like I catch them all, but thank you very much for the and
you know what, Blake, we also have Mr. Discipline, Steve Olge. He's one of the best traders, analysts, tacticians I've ever seen as well. And then you have Grega. He's been an award winner on FX Street several years running. And then you have Stelios, who loved crude in the low 40s, said it would be 60 by the end of the year. And then Amanda, who you brought on she's doing a great job in the Project Chat. I mean, where can you find all of that in one place?
You see Amanda trade in the chat room. It's pretty outstanding. She's she's a single mom, trading like a freaking bandit. It's pretty awesome. But yeah, we have a really great team.
Andre's putting out winning pips. I mean, you know, it really is a great team. I don't think anyone could debate it.
Yeah, I agree. Now, wait, let's okay, I'm done patting myself on the back and patting everybody else on the back. Okay, let's talk about them. You need your shoulder rub too? Do it. Yeah. Okay. All right. So let's talk about the euro dollar, where we're trading right now. And I did tweet it out this morning. I want to be very succinct here. Is the euro yen is breaking lower, and if you're wondering why, one of our traders is like, man, what happened to the dollar yen? I think the yen is it's starting to feel the heat from the crosses, and it's not just. You might go, well, the dollar's so bid, but you guys understand that the dollar yen is in breakdown territory. No matter which, unless we break above 108, which we could. I'm not saying that we won't, but unless we break above 108, the dollar yen, the trend is lower, and we've broken a multi-year trend line. I mean, this is multi-year trend lines are not something that I turn my nose to. It is when you break a multi-year trend line. That's something that becomes very significant in my intraday trading. So, I can't, for this reason, unless we get above 108, you're not going to see me trade long the dollar yen, period. Intraday, and end of story. And hey, look, the dollar yen could have like yesterday, probably had a 60 pip rally, whatever yesterday. I mean, we went from 106.40 to 106, had a 100 pip rally. I'm not going to catch it. I just won't catch it. That's just not something I'm going to do. But if you look at not only what's happening in the dollar yen, you look at the euro yen that's getting blasted. Pound yen's getting destroyed. Pound yen's coming out of a really key ascending wedge, broken trend line. I mean, the pound yen's getting destroyed. Aussie yen, we're approaching channel lows. New Zealand yen's getting, walloped. Canadian yen, big double top. I mean, you can't, you look around and you go, okay, well, now I have a really good understanding of what's happening with the yen. So and that's going to translate into other pairs too, because the yen crosses do, for their own right, have a lot of liquidity that gets pumped through them. Probably like out of the top, 15 currency crosses in the FX market, these ones that you see right here are in those top 15. They're going to have a lot of liquidity that gets pumped through them, so they are going to have an effect on the majors, which would be like the euro dollar and pound dollar and yada yada yada. So to see the Canadian, the dollar Canadian has broken above its 200-day moving average and breaking out, there shouldn't be any surprise that we have a bull flag formation and it's breaking. This is not surprising to me, and if you use ForexAnalytix, it's not surprising that we have a bull flag and we're breaking out here either, because you got the analysis this morning. But I look at the euro dollar, and we have a lot of risks heading into this weekend, which I'll let Stelios and Steve talk a little bit more about the Italian elections this weekend, as Stelios has put together a really great blog on the Italian elections, kind of a little cheat sheet on it that you guys you'll be able to read here in the next 24, 48 hours. Ooh, excuse me, as we get closer to the weekend. But the euro could feel some pressure just from that alone. But if you take into account yesterday's Powell testimony, okay, if you listen to the whole thing, it was a painful 4 hours of I mean, I listened to the whole damn thing right up until it ended, and the last hour and a half, I really wanted to, put a bullet in my skull. However, he did say something that was really important when he talked about rate hikes and monetary policy. He basically stopped short of saying we have 4 rate hikes coming in 2018. He said 3, and he goes, but the economy is strong enough that as the data comes in, I'm going to have to reassess and then he stopped short of what he was saying, basically hinting that there could be 4 rate hikes. So the market is pricing in 3 now, and quite possibly we could have 4 rate hikes coming. And that's why, if you wonder why the dollar strengthened and why the euro dollar broke lower, that's the reason why. And so, you know, you take the euro dollar, here we are, very vulnerable. Again, I'm going to reiterate things that I've been saying for the last couple of weeks. You know, when we had this false breakout, this is concerning for anybody who is late to the party here. And I know I've been saying this over the last month, is that the sentiment has been so extreme bullish in the euro dollar that there was so much FOMO, you know, the fear of missing out in the euro rally, that funds are very leveraged long the euro dollar right now, and we start breaking below 122, things could get a little dicey, you know, 122, 121.80, and we could trade down to 121 pretty quickly. And with the Italian elections this weekend, I don't really see that being too big of an issue. Now, is, you know, the euro dollar, is the uptrend over? I doubt it. I can't sit here with, you know, in my right mind and say that I feel that the dollar is bottomed and there's reasons to be long the dollar now. I can't really, I can't, let me put it in a different color there. I can't really justify that in my mind, okay? But if you can see this little dotted line, it's very faint. I'm trying to make it a little bit darker for you guys, and maybe I'll just make it a little thicker too. What seems to me that's going to happen is the euro dollar is going to, you know, see 121 again, and once it sees 121, it's probably, you know, if I had to think it out, we have the Italian elections this weekend. The euro dollar slumps towards 121, and then it's like everything else in politics. People take a step back and go, it's not that bad. Look, you know, Donald Trump became president. The market adjusted. You know, if Hillary Clinton would have become president, the market probably would have sold off and then readjusted again and said, oh well, you know, she's one person. She's not gonna, you know, can't run the entire, it's the U.S. economy. You know, it's like the, you know, the political climate may be a little bit more negative based on the outcome for the Italian government, but is it going to really change the landscape of the euro and monetary policy and how the ECB is positioning themselves moving forward? Probably not. So if the euro dollar sees, you know, some sort of sell-off from this weekend, and we see 121, is there much more downside than that? I don't know. I'd be willing to be a buyer of the euro dollar down at 121. However, there are some tailwinds for the US dollar because of Powell's testimony yesterday, the Italian elections. It's also end of month, and you know, based on what I'm reading, there might be some dollar demand going into the end of month. So we could see some continued dollar strength here, but I think it's very limited. I don't think that the euro is going to see much lower than 121. Could we? Sure, we could. I mean, I can't see it. I can't foresee it, but it could happen. And if it does, then things are going to get a little squirrely, just from a positioning standpoint. Then we could probably see like 119, 118 as longs get destroyed. But you know, it's hard for me to envision that at this moment in time. But I do think that the dollar is poised to continue to rally here, especially if we break this 122 level. Are we going to break it today? I think that the risks are that we do at least probe stops below 122 today. Anybody who's long the euro or who's been buying it here has stops below 122. And so I think that those stops are now at risk at being triggered. Again, is there going to be massive follow through to the downside? I doubt it, but you know, it could happen. Yeah, it could. And that's, you know, I think that's entirely possible still. The cable. Okay, if you guys haven't seen the cable has been underperforming the euro dollar, and we broke below this triangle support, and man, the cable is just getting walloped today, and I'm so upset that I'm not short the pound right now. I should be short the pound and up 100 pips based on my short yesterday. I should be up more than that actually. And I was just a couple of things that, and I told the guys in the chat room yesterday, because Chi had asked me, "Are you still not bearish the pound?" I'm like, "No, I'm still bearish the pound. I just wanted to preserve my day that I had yesterday." Like I told you yesterday, or I told you earlier, Dale, yesterday was one of my best trading days of the year. I didn't want to give that back. And I put in an order last night, and matter of fact, it might even still be out there.
You know, that's a great point, Blake, because, you know, a lot of people, when they have windfalls, they begin to trade looser, okay, because they go, you know what, it's the house money. I'm trading with house money. You know what, It's not the house money. It's now your money.
Yeah, I don't do that. I'm very much, I try to, well, it depends actually. I take that back. Sometimes I will, but you know, in the case of yesterday, I made such a good amount that I'm like, I want to walk away and be really happy tomorrow, you know, yesterday evening, and I want to have a good night and not worry about anything. And as I told, you know, Chi, I said, no, I'm still bearish. Those guys were in, you know, the people that were in our chat room yesterday afternoon, you know, probably heard me say this. I said, it's not that I'm not bearish. I just didn't want to mess up my trading day. And I put in an order. The thing that sucks about the pound is I put in an order to sell the pound dollar at 143.49, and the high, the high today, no, 45, sorry. So the high today was 139.39. So I missed my order by 6 pips last night, which really stunk because what I did is I measured this. This was a 618, just so you can see this. This is why I put in my order where I did. I put in my order right just ahead of the 618, or right around the 618 here at this 139.45. And we came within 5 pips of me getting 5 or 6 pips of me getting hit, and then it just rolled over. And I'm a little ticked off that I missed that. I woke up this morning thinking, oh man, I think I got triggered, and then of course I didn't. So it happens. I mean,
but you have to sleep, Blake. I'm sorry to say
I do.
Require that you sleep. Yeah.
I slept well last night, so
right,
you know what can I say? I did. I had a good night's sleep. And actually, the same could be said for the euro dollar. I actually put a euro dollar short at 122.40 or 59, and I didn't get triggered in that overnight because I was trying to sell this previous support here. That didn't happen, and then I'm short the euro now from this morning. But anyway, it's relatively small position. What I'm thinking is that the euro dollar is going to just take stops below 122. Cover.
Sorry to interrupt you. We have in a few seconds preliminary GDP. Yeah,
thank
it's
you. Well,
just 30 seconds away.
Oh my gosh, here we go. Well, I guess I'm going to stay here for it. All right, let's see what the GDP numbers are. Thank you, Steve. We are expecting 2.5%. Prior was 2.6. I'll give you the number as it happens. I'll give it to you before anybody else, actually, since I got it on Bloomy here.
By the way, I think a good print obviously should be dollar positive, and that might prove to be stock negative. I don't know if you agree.
Annualized, hold on. I don't know if it'll be stock negative.
It depends according to how the market reacted yesterday.
2.5% as expected. Sorry, 2.5% as expected.
Point. Okay.
Yeah, so it's in line as expectations. Not seeing a big move in the dollar here. It's just a little bit of dollar lift, but not a lot.
We also had Canadian industrial production, 0.3 versus 0.5 expected month on month. So, you know, a little bit below expectations.
You know, GDP price index came down slightly. So just 2.3% versus 2.4. So we might see a little dollar weakness. That's why this dollar weakness is coming in slight. That's why. All right. Well, with that being said, Steve, good to hear you. I'm going to pass it over to you guys. Have a good interview with Andrew Thrasher. I'm going to go back and listen to that one later on today. Yeah, that should, thank you. That should be a really good interview. So you guys stick around for that.
Yeah,
all right,
Charles Dow Award winner for
That's
volatility.
awesome. I think it's going to be pretty awesome interview. All right, guys, enjoy. Have a great day. Good luck today.
Thank you.
You too, Blake. Bye-bye, mate.
Steve, congratulations on your index short. Isn't that a great comment and testimonial that we're getting from Kurt in the questions?
Let me see.
Check it out.
Yeah, it absolutely is. I just saw it. I've learned more about Forex, etc., with you guys in less than 2 weeks than I have elsewhere in over a year. Thank you very much, Kurt. I mean, you know, that's the most important thing for us, in all honesty. Yeah, it is. It is. And we also had, if I read somewhere, a funny comment about Stelios. Yeah, if Stelios is going to comment about the Italian elections with an Italian accent. Yeah, actually,
yes,
Stelios.
Of course, I'm going to do that. No. In fact, we were putting together a blog post on the Italian elections.
Exactly.
Tomorrow or something like that. I don't know.
Yeah, Stelios is putting on the macro stuff. I'm going to putting on the technicals. There's a good likelihood that Greg and Blake will also want to pitch in and you know, do one of our usual.
Stelios Corleone, Godfather. I have a favor to ask.
So, okay, let's start because we have quite a lot of things to cover. Blake obviously covered quite a lot of ground. I just want to know, I don't want to overlap with what Blake said because anyhow, I have no disagreements with anything there. I just want to say that, you know, we said several days ago that it's likely that the pound is in a channeled correction, right? So it showed yesterday as well that the interpretation of a triangle is more probably not the correct one, and the correct one will likely prove to be this one of a channel. So I think that, you know, expecting one more move lower towards this area, as we had drawn here, is quite likely. So I do believe that the cable, you know, might remain under pressure and might have like more downside. But honestly, if we come down to this 136 area, I would be very, very careful. Okay. So just want to add this having to do with the cable. Now, having to do with the euro, I have absolutely no disagreements. I'm also looking for 121. There is a likelihood, obviously, that we're going to see some gap down after the weekend. And as Blake said, very often, especially when we get gaps due to political developments, we see them being retraced quite fast because then the market realizes that, okay, come on, it's not the end of the world. I mean, you know, we've seen worse happen, and you know, the economies and the eurozone, etc., will still move on. And then, you know, the market dismisses the news and it goes back to do what it wants to do. In the case of the euro, it's very, very likely that what it wants to do is move higher from here. That being said, we already said yesterday, and we warned that, you know, euro yen and pound yen were sitting on very nice supports, but the price action, as we clearly stated, was pointing that these areas are not going to hold, and we're actually going to penetrate through. So, you know, after 3 days of, you know, euro yen trying to hold the 131 area and the 200 EMA and the 61.8, it finally broke down today. I think that opens the door for a retest of the 128.70 area. And, you know, the pair remains very heavy. Now, the situation with pound yen is probably much more dire if we break below here, which we're testing at the moment, because the 147.50, 148 area is quite more important than the 131 area was for the euro yen, right? As you see, we saw this yesterday. We said that, listen, this is more likely than not a triangle, and we all know what happens to triangles. They break, in the vast majority of the cases, to the direction of the previous move. In this case, obviously, the direction is lower. And currently, as you see, the pound yen is testing horizontal support area, 200 DMA, and this ascending trend line support. So in essence, pound yen is currently on a triple confluence of supports. It's also the 50% fib from that last move higher. So you can call it a quadruple confluence of supports. Okay, you understand that if we break below here, and given the fact, as I was explaining yesterday, that I'm pretty sure that a huge amount of stops are somewhere here in the market, you know, it's going to be very nasty if we actually confirm a break below there, because I think that only you know, weak longs covering positions and other people getting triggered short is going to probably fuel a strong move to the downside. Okay, so be warned here. You know, the pair is currently at the do or die level, and especially given the fact that we just broke below a triangle, you know, this market also looks like it wants to move lower from here. Now, let's go back to the DXY, which obviously proved we had warned about it. If you remember, Dale, when we were trading here, expecting for news 2 days ago, to trading days ago, I said that the market was nicely positioned for.
Yeah, we call the bull flag.
Yeah, a pennant in this case, but it doesn't really matter. Yeah, you know, the market having to do with all the pairs that we were looking. You know, you can't do an opposite analysis. Say that, oh, the market, you know, technically looks like that, so that means that the news that are going to come out are going to be X or Y or Z. But definitely, we had said that the market looks very nicely positioned for dollar positive news, because everything was about to break to the upside, having to do with dollar, right? And indeed, that's what happened. So now the question is, what happens from here? What happens from here is the following. You know, it's been a nice move, but we've said since the very beginning that 91 is going to be a critical level. And once we break 91, that's exactly what we drew there. Then the next zone will come up to test, and I think that, you know, a break above 91 will probably create enough of a squeeze to see that is the 9250 area. The 9250 area, if you see, is a triple area of resistance, right? It's the descending trend line that you see from there. It's the 61.8. It's a horizontal support resistance area. So 9250 then is going to be like, you know, the most important level for the dollar for the whole year, simply because this will be an area that will confirm that a larger correction higher has started for the dollar, if of course it breaks above there, or that the bearish trend is resuming if we get rejected from there. So, you know, my eyes are focused for 91. We're currently at 90.70, so we're getting there. And if we break above there, I think that there is a good chance we're going to see enough of a squeeze to get us to 92.50, and then what happens from there is going to be super important and might shape, you know, the technicals having to do with the dollar for at least, you know, several weeks or even months to come.
Steve, you know, yesterday we talked about that Powell could be talked tough because of the level of the S&P. I'm wondering what you think. You know, today he's speaking again to the Senate. After he saw the market impact of what he said, if today he sounds a little bit more dovish, you know, to kind of settle the markets down after yesterday. What do you think?
It's not going to be the first time we're going to see something like that, right? We've seen.
Right, that's what I mean. That would be the tradition. Talk tough, and then they go, "Oh, maybe I was too tough."
Yeah.
I'm spooking people, and maybe I should just, you know, put my dove wings on for a day.
It is very likely. It's not going to be the first time we've seen that, and we've seen how how important for the Fed is. Of course, they're dismissing every hint of that. And Powell did the same yesterday as well, by saying that no, we're not, we're not acting according to what the stock markets are doing, etc. But we all know they are, right? Because
Yep.
we all know
The wealth
that
effect.
exactly.
But the whole thing was a wealth effect to force
Exactly.
people into taking risk by having financial repression and not paying savers.
Exactly. We all know that this recovery, as well as the previous recovery, was in essence expedited, somewhat manufactured from the Fed, based on the fact that if you pump up asset prices, the wealth effect, as you very well mentioned, might probably help you do the rest, right? Might help the economy pick up, might create more jobs, etc., etc. So we all know that since they do know that this is the method with which they manufactured anyhow expedited recoveries, how important it is for them to maintain asset prices at high valuations, and people very interested into not saving, as you said, but actually investing, etc. So yeah, it's very likely. What you say is very likely, and keep in mind that if we have a look at S&P, for example.
Yeah, I'm curious. Did you go the door on some yesterday, or are
no,
you
but
holding?
I'm thinking. Actually, I started the day yesterday with 1/3 of a position, and I actively traded the S&P. I added higher because at the very beginning of the day we were trading at the highs, and I wrote at the chat room after we got Powell's statements. I wrote to the chat room that, listen, we are positive on the day, but I'm really not buying, seeing what the dollar is doing and everything else is doing. I'm not buying into this stock market's price action, and I'm adding more to my position. And then when we started showing initial weakness, I added even more to my position. So in essence, I ended up adding 3 times yesterday to my position, and I currently have a cost average of 2,774, 73.8, something like that. So I'm thinking of perhaps booking some, because if you see the chart here, and if I take it down to the 4-hour chart, you're going to see that we are sitting on some soft support here. There we go. Let me mark it. You can see it here, right? We had some consolidation here. We had a high here, another high here, and now we are probing this as support this time, right? So
right. That's why
I'm actually thinking of booking half of it here, and then moving my stop loss above the highs. My stop loss is already above the high. Yesterday, after the initial move, I said that I moved my stop loss above the high, but I mean keep my stop loss just above the high for the rest of the position. So in essence, have a completely risk-free trade from this point on. Regardless, obviously, especially if we confirm a break below today's lows, I think that the next area of support is down here, which is below 2,700. So it's like 2,600 and let's call it 90 roughly. So I think that a break below here is will be good enough for roughly 50 handles. 50 handles doesn't seem much given the very recent price action, but you know very well that 50 handles is not something to dismiss, right?
Yep. Yeah.
So I think that even if somebody is not involved yet, a break below this area at least offers a 1-to-1 reward to risk ratio having to do with yesterday's high. So I'm saying that the trade is not dead yet. I mean, there is still an opportunity for people to try to catch a move here.
Especially if we have a hot NFP on Friday, right? That'll only reinforce what Paul said yesterday.
Absolutely, because it's more than obvious that the inverse relationship between the dollar and stocks has somewhat come back for a long period of time.
Ziggy's saying he speaks tomorrow, not today. So thank you, Zig.
Reason this here today. For some reason this here today. Okay. Yeah. Okay. Okay, so that's it having to do with stocks. So keep that in mind. Let's have a fast look of the rest of the indices. Obviously, Nasdaq, was the better standing one. Not yesterday specifically, but as you see, Nasdaq almost reclaimed the highs, right? IWM, I think you mentioned it yesterday as well, got rejected from a very interesting area of resistance. We had marked that since a long time ago. As you see, this is a horizontal level of support resistance, and we got rejected from there. On the other hand, we have to mention that the IWM held a very important support, right? It was this ascending channel support. So we held a very important support. It was also the confluence of the 200 DMA, but we saw a massive rejection yesterday from that area of resistance. So it wouldn't surprise me to at least see another push to test this trend line, even if that is to hold once again, right? Obviously, if we break below there, things will start, getting really nasty. Now, having to do with the Dow, it's more or less in the position the S&P was. You can see it here, almost reached the 78.6, gave us a nice reversal yesterday. There is also a nice gap to fill here. Same situation, more or less. If we see today, weakness, I think that, there is a decently more downside potential ahead. Now, having to do with the DAX, this is what we've been monitoring on DAX. We got a nice rejection yesterday from there. Now it remains to be seen what kind of a situation we have here. Was this like a flag and we're moving lower? Quite likely. But, obviously, we have to be a little bit patient. The Italian elections might play a role. I think what's holding the DAX from not breaking down below this is the fact that the euro is weakening. And we all know that, when the euro is weakening, obviously, European stocks are going to be somewhat supported because they become cheaper for foreigners, right? For foreign investors. So having said that, I'm pretty sure we have plenty of questions. So, let me just briefly mention about the Aussie and the Kiwi. I remain obviously short the Aussie. I would have liked to see some more momentum to the downside, but still, the pair looks fine for more downside. And definitely, the Kiwi has finally started doing some catching up, and it's currently testing very important horizontal support. If we break below here, let's call it roughly 72, we actually trigger a double top formation, which, as you understand, makes this a range, makes this a double top formation, and then should extend an equal length. Roughly, I would say that we should at least then expect the 61.8 at 70.30 to be tested once if we confirm a break below here. So I think that the break below there opens up quite a lot of downside. It's an air pocket here for the Kiwi, okay? And because I had a question, and thank you, Zach, for your kind words. Great webinar as always. Secondly, do you think once Aussie Kiwi settles more than the Aussie downside should resume, differentials, housing market, lurking, etc., should, in my opinion, should start to reflect here? Well, should have a while ago, so still waiting on this. Thanks in advance. I really appreciate you and the gang inside. Always top notch. Thank you very much, my friend. Okay, having to do with the Aussie Kiwi, we showed yesterday, I mentioned yesterday explicitly that, listen, I was believing in the downside of the Aussie Kiwi, and technically it was acting very nicely, but this is an inverted head and shoulders formation, right? That's what we showed yesterday on the 4-hour chart. And it seems to have been working very nicely because we actually broke the neckline, we consolidated a little bit, we thrust it higher, and now we're getting back to a very important resistance area, support resistance area. If I go back to the daily, there we are. You're going to see that this area, the 1085, has acted several times as support and resistance. So, we might get rejected from there. It's quite a good chance. But if we do break above 1085, I think that we might see Kiwi underperforming Aussie this time for at least several more days. Okay, so as long as we remain below there, sure, the Aussie can remain the weak sister, weak brother, you can call it whatever you want among them. But let me reiterate one last thing I said yesterday, is that, you know, we're seeing technical levels and the Aussie Kiwi has been rather technical, and there's no question about it. And somebody can even mention this, I had said it a long time ago, you can view this as a head and shoulders formation, not the prettiest one, but it is one, and this being as the neckline. So in this case, a rejection from here, it's going to look pretty fine. Why? Because we had a head and shoulders formation, we broke below it, we came back, we retested the neckline, and we resume lower, right? This is an extra reason why the 1085 area is very, very critical to the trend, and obviously very, very critical to the cross-currency performance and how the Aussie is going to be performing against the Kiwi. Having said that, though, seeing the big picture, you can easily realize that since the very beginning of 2014, the Aussie Kiwi has been trapped in a large range, and you can even call it a contracting range because the bottom side of the range is an ascending trend line, while the top side of the range is horizontal, right? So given that interpretation, we're currently trading in the middle of this large range. So in essence, for at least a period of 3+ years, the pair can be considered in a long-term chart, you know, without a trend, right? It's range-bound. So I would probably avoid making predictions about the long-term, you know, outcome for this. If I had to do, though, I would definitely have to mention the following. This was a large move to the downside, right? Unquestionably. And this can easily be a prolonged consolidation before the next move to the downside. Meaning that this structure on a long-term chart looks like corrective after a very strong move to the downside, which says that, yeah, we currently have more or less nothing to do because we're in the middle of the range. But if we had to point a finger and say, okay, when this range finally breaks, in which direction is it more likely to do so? I would say to the downside. Okay. Paul's, yeah, we read Ziggy's comment. Paul is today again, I think, in just over an hour's time. No, I think Ziggy's right, actually, Zach. I think NFP is only next week. Cheers. Hello, what is your opinion about EuroCAD? Let's have a look at it. My pleasure, Zach. Let's have a look at the EuroCAD. And you know something, actually, for some peculiar reason, because you usually ask guys and girls, nobody has asked today about the cross rates. So let's have a look, because we haven't done so in a few days. Let's have a look at Euro Aussie, EuroCAD, Euro Kiwi, Pound Aussie, Pound CAD, Pound Kiwi. So let's begin by the Euro Aussie. Okay, Euro Aussie is obviously consolidating. This is a very choppy consolidation. Obviously, this points to a break to the upside as long as this doesn't take much longer. Because, in all honesty, you know, you prefer flags to break sooner before they become too prolonged, and now it's more or less starting to become, you know, a long consolidation. Regardless, the chances are still for a break to the upside, but I would like to see that sooner rather than later. Okay, so Euro Aussie remains constructive with this little asterisk that I just mentioned. Now, having to do with the Euro Kiwi, first of all, the Euro Kiwi more or less has managed to hold this ascending channel. Second of all, it has managed to remain above the inverted head and shoulders neckline because it's inclined, as you see. It's downslope And we came back, we retested it, and we're pushing higher from there. Now, does that mean that the euro Q is bullish? Yes, it is. But obviously, there is still no upside momentum here. I mean, momentum is lacking, which would make me skeptical, and this is why I'm not participating here. I'll probably be looking to buy a breakout in the euro Aussie instead of the euro Kiwi, at least as long as we remain in the Aussie Kiwi, as I said, below 1085. Right. Now, let's go to EuroCAD, which the initial question was for. Nothing has changed since yesterday. We obviously are seeing some momentum loss, but as I said, the next upside target is the 161.8 of this corrective move. And, one thing is, without a doubt here, we've been in a period since we found a low here in February 2017, so a year ago, that what have we had? Higher lows, right? So it's impossible for me to tell you that, oh, I'm bearish this pair. But what I can tell you is I wouldn't be buying it up here. I mean, we're getting very close to a very important, golden fib, the 161.8, and we're obviously seeing some momentum loss. So I wouldn't be buying it up here. I think that, you have two choices here. Either wait for a corrective move lower towards this trend line and then attempt to buy it, or if you're really an adventurous type of person and you look at some kind of signal that you believe it's a nice reversal signal, try to short it for a counter trend, shorter move, or nothing else to do. Because buying it up here, where would you put your stop loss and where would your target be? Bottom line, there is no reward to risk to be buying up here, right? So you're either long, so you're holding your position, obviously having trailed your stop loss or having taken, already some profits, or you're just waiting for a corrective move lower. That's the situation here. Now let's have a look at the pound crosses. Okay, this is the pound Aussie. I had mentioned some time ago that obviously it remains bullish. We had seen this ascending channel after the corrective move lower, but there is a problem here. First of all, I had mentioned that the upside momentum is also lacking here, and this is what made me skeptical. Second of all, there is a possibility here as well for a double top. Obviously, for this to get triggered, we need to move lower from there. I would say I would at least want to see a break below 176, but there is a potential for a double top. Bottom line, in the longer term view, in the medium term view, we remain bullish because we've been producing series of higher lows since middle 2017, but the upside momentum is definitely not one you would expect in a move that wants to unfold further to the upside. And second of all, we're now seeing this break of the ascending channel. And if we also see a break of this horizontal area of support, I think that another move towards at least the 173.60 area will probably begin, right? So I would be cautious. My preferred position for this person at the moment, as you've understood, is being sidelined. And this is the pound Kiwi. Now, we said that this might be a bullish consolidation, right? But this might last longer after the larger break higher from this triangle. Now, we got rejected from this trend line again, which obviously is not good news if you're bullish. But on the other hand, as long as this blue trend line is holding, there is always the possibility to see like more prolonged consolidation and then break to the upside, right? So one more case in which I wouldn't be buying here for sure, especially since we got rejected from this trend line as well. But definitely I would also not be bearish as long as we trade above here. So this is also one more pair that it needs for you to be more patient, in my opinion, and wait for confirmation before you do anything else. And let's have a look at the
Our
pound
guest
as
is
well.
going to have to be patient if we don't wrap it up here pretty soon. It's now time.
I'm done. I'm done, Dale.
Are you,
Give
buddy?
me 30 more seconds. Yeah.
All right, so just
30
go
more seconds.
get ready to book some of your S&P shorts. And great review,
okay,
and congratulations, Steve, on what I said on Twitter. I'm not patronizing you because I work with you. I've seen hundreds upon hundreds of people trade and analyze markets, and you are one of the best market tacticians, analysts, and traders that I've seen. So
thank you. You make me blush.
You're in the top 1,000.
You know something? That's I really hope that's true, because we are 7 billion people.
Yeah. All right, Andrew, I see you're in the house, and
okay. Enjoy the interview. We'll check the rest tomorrow, guys and girls. Thank you very much.
Okay, Steve. So, Andrew, I'm going to make you the presenter. Looking forward to saying hello to you and possibly seeing your screen and talking about your journey and what's happening in the markets nowadays. Any issues?
Let me just get to a point where I can share my screen. I wasn't planning on showing things up. Give me a second here.
You got it, buddy. So Andrew is a CMT with Enhancement Group. I'm guessing that's an RIA.
Financial Enhancement Group, yep. Mm-hmm.
Yeah, okay. And also won the Charles H. Dow Award for your work in equity market volatility. What a great time to talk to you after what happened a few weeks ago. So I'm still waiting for your screen. Are you trying to show it?
Yep, give me 1 second.
Okay, buddy.
All right, I know I can do this.
If not, I could show your website. There we go.
All right, we can use this.
Okay, beautiful. Tsunami. Yeah, it definitely was, Andrew. So thank you so much for joining us. I'm certainly glad that you accepted my invitation to address our community here. And I just told people where you're at now. I like to go back to people's beginnings of their journey of how they got in the business. And I also read on your site that you majored in finance when you were a Boilermaker, not drinking them, but as a student, as a student of Purdue. So
that's right.
So you knew then, or did you know prior that you had an interest in the markets and someday we're going to be advising people on what to do with their money?
Yeah, my interest in the markets probably started when I was in high school. We did, I think it was my senior year, we did one of those kind of an economics class where you do a virtual stock trading, where you have a fake investment account. And,
yeah.
That kind of doing that kind of gave me the bug a little bit that this was pretty interesting. And I started, it was kind of a contest for our class of who could make the most money in a set period of time. And towards the last couple of weeks, I was actually managing some of the other kids in my class's fake accounts because I've been winning the entire time. So I started, I guess you could say I'd managed fake money in high school. But went to Purdue, like you said, and majored in finance, financial planning, and kind of went down that route. Worked for an RIA in Florida as an analyst there, and then I've been at my current firm for the last 6 years, working as a portfolio manager, managing our clients' assets. We manage for about 800 families, about $360 million.
Nice, congratulations.
Yeah, it's been a fun career so far.
You know what? Maybe we could start with the CMT designation certification. You know, a lot of people don't know what it is, and
sure.
And it's really not easy to get, is it? It takes some time and energy and diligence to get that.
Yeah, Yeah, it's three exams. The first exam is more kind of an introductory, learn what basic technical indicators are, candlesticks and trend lines, things like that. And then the second exam is a little bit more application. And then the third exam is actually essay-based, which is a little unique compared to some of the other designations out there, other investment exams and whatnot, where they'll do different sets of questions, and then they bring all the kind of experts on each question together to review that. So if it's a question on point and figure, there's going to be one person who's an expert in industry on point and figure who's going to grade that question, and it takes them a couple months to get through it all.
Who do you remember who was the expert on point and figure?
No, they don't.
I mean, that's kind of a lost art. You don't.
A lot
of people don't do it. Go ahead.
They don't know. They don't tell us the specific people of who's grading. Probably just kind of, if you fail, you don't try to seek them out.
Right.
But it's a unique way where it's not just a standardized test, where they really do want to make sure you understand how to use it.
Okay.
Yeah.
So all right. Well, it's I'm interested. When you were writing about equity market volatility and won the Charles H. Dow Award for it, there was none. It was suppressed. We had that spike in 2015 on the Wanda valuation, and we went to 50. And it was Groundhog's Day when they finally buried all the short volatility players and spiked again to 50. Is this August 2015 all over again, or is this a different regime that we're entering where, it used to be normal in the old days of having 15 to 20 vol, and the last few years people think it's normal to trade at 10. So trading here at 18 after yesterday, what did you write about when there was no volatility? What was the theme of the paper?
Yeah, it was kind of interesting. So I won the paper last spring. So it was right before we went into this environment of volatility essentially disappearing, which is kind of ironic to win an award writing about volatility, and then essentially volatility's gone. So that was a little a little funny. But we really have had, what my paper was about was trying to find different methods to forecast volatility. Often people will say because volatility is really low, that's what's going to send volatility higher. Last year was a perfect example of that. That methodology really doesn't work. And so as a portfolio manager, I'm looking for ways to manage risk. Volatility obviously plays a big role in that. So I was trying to find times where, is there any commonality to these big spikes in volatility? And so this here, what I just have on my screen is a presentation I did at the University of Chicago a couple weeks ago. I'm just going to clip through some of my slides just to kind of better explain that.
My hometown. So you and I are Midwest guys.
That's right. That's right.
Yeah. Are you still in the Midwest, or
yeah, I'm still in Indianapolis.
Okay. I couldn't take the winters anymore. I left
they're
a long
tough.
time ago. Okay, so here we go. You're talking about 30% spikes. Go ahead.
So in the paper, I define kind of a spike as being a 30% move in the VIX. Obviously, it's not correct to talk about percentages moving in percentage terms, but this makes the conversation easier to have. So just I use this chart just to show that it's pretty common for us to see 30+% moves within the VIX. It doesn't just have to be black swan events. It doesn't just have to be recessions like 08. And then just looking at times where volatility dropped. So if we just look at if volatility were to move 15% lower in 3 days, that happens pretty consistently, but it doesn't necessarily always mark a low in volatility. So just saying because volatility has come down a lot, then it must mean revert higher wasn't a great indicator. So then I said, okay, well, what about if volatility were to close at the lowest level in 4 weeks? Saying it's been declining for 4 weeks, we had a 4-week low. That must mean that it's going to revert higher too. But what I found was that 4-week lows were often followed by additional 4-week lows and more 4-week lows and another 4-week low. That they never really marked it or were a good methodology for finding times where, okay, this is where volatility is at the highest risk of spiking.
That's a pearl. That really is a pearl, Andrew. And, doesn't that also carry through to almost any instrument? A lot of people, when things are making new 52-week lows or historic lows, have the assumption that means it's a value and it's going to turn. When I use the retail store analogy. If you go to a you go and buy something, that's cheap, you bring it home and it breaks within a week or two. So
Yeah,
buying
right.
something cheap could also mean a break coming. So
Yeah,
yeah,
it can always become cheaper.
right. Okay.
So looking at low volatility, I just want to see, okay, when is there any clustering of when volatility spiking higher? So I said, okay, give it 3 weeks. What's the largest increase in volatility at the different levels in the VIX? And so this shows just on the bottom axis here, you can see the different levels of the VIX and then the 3-week moves. And it's pretty diverse. You could have big spikes higher, 150% moves in 3 weeks when VIX is in single digits, all the way out to when VIX is at a 40 level. So just that wide of a gap isn't enough to tell us, okay, if VIX is at a certain level, that's what's going to set it higher. So what my paper's about was looking at the standard deviation of the VIX. So looking at the movement of volatility. And when the standard deviation gets really low, that's telling us that there's not a lot of day-to-day swings within the VIX. It's become very, very calm, which is why I titled the paper kind of Forecasting a Volatility Tsunami, meaning that oftentimes before large weather events, maybe things get very, very calm, the water gets a little placid, and then you have this giant wave that comes and crashes us.
Eye of the hurricane.
That's exactly. And so doing the same kind of scatter plot, looking at the VIX standard deviation, we can see that they all kind of cluster, that we see the biggest 3-week changes in volatility happen when the standard deviation is extremely, extremely low, meaning dispersion in the VIX is very, very low. So now I say, okay, we're on to something. At least we're getting a little bit of clustering. The biggest moves happen when the standard deviation is low. Because what this often means is that people think when standard deviation is low that the market's stable, that we're in kind of a calm period. We're not seeing markets in turmoil on CNBC, but it's a stability that actually leads to the chaos, kind of a Minsky type moment.
Okay.
So just kind of plotted just to show you previous time to all the instances, and I go into much more detail in the paper, but just to not belabor the point, that these red dots show when standard deviation gets into about a 15th percentile for the VIX. So we often see that these do end up marking major turning points within the volatility index. And just kind of click through.
Were we there? Were we there in February before the mini panic? And I also want to ask you what we've noticed and what I've noticed is when the market is going up and the VIX is going up too. Mm-hmm. You know, VIX is performing when it shouldn't. With the market blowing off, they're not taking it down. Is that a market tell in your volatility studies? Well,
I'll answer your first question first. So yeah, we did. I sent out a tweet on January, I think it was January 10th, saying that I thought that we're a point where volatility risk was becoming very elevated, and that was like at VIX 9.5, and that's because while we were starting to see this very tight consolidation, along with a lot of other data that I look at, but a piece of it was this. And so the second part of your question, when volatility and the S&P are rising together, it's important to remember that the VIX is a measure of 30-day expected change within the S&P options. It's not directionally biased. So right. that expected change could be higher or lower. Oftentimes the VIX is negatively correlated. I think it has a long-term correlation of negative 0.8. But just because VIX is going up doesn't necessarily mean, I don't think that's a good enough predictor, because I think there's a lot of messy data within that. But earlier in our conversation, you're asking about 2015. So here's a chart of when we had the big spike in volatility. We had 3 instances where volatility got really, really low. One of which, as you can see the third circle there, where we did see standard deviation get very compressed in early August before VIX went from 12 all the way up to 50 intraday up to 50. That was
the quant evaluation. Dow came in 1,000 lower and recovered.
Yep. And so we look at the flash crash. We saw the same thing. Before the flash crash, the fat finger trade that happened in May. Back in April, we saw volatility once again got really, really compressed, giving us almost a month's heads up that we're about to see a volatility event. Look at the financial crisis. When VIX was still trading under 20 in September of 2008, we did see, just for a very brief period in early September, the standard deviation on the VIX got really, really low just before VIX went from 20 all the way up to 80. One thing that I think is really interesting to look at is the CBOE actually gave us the data to look at the VIX, even though it wasn't around during the 87 crash. They kind of back and filled to show us what the data would have been if we had a VIX. And so this is just using kind of Excel data, using the COBE's data set.
What was the number? 50 again? That magic number 50 in 87? It would have been 50.
It would have gone all the way up to 50. Yeah. So this blue line here is the VIX. It got all the way up to 50 from 50, a low of
50, 50, 50, right? 50 there, 50 and 15, and 50 a week or so ago.
Yeah, that does seem to be kind of like the ceiling for it. But we did see standard deviation. So the red line here is standard deviation for the VIX. And so we can see right before Black Monday, before the 87 crash, we did see a very tight dispersion in volatility markets. So this just shows that there's, even before we even had the VIX, that the standard deviation, this tight dispersion, has been a very good predictor of events. So even before some black swan type events, the 9/11 terrorist attack, we did have, not necessarily right before the event, but early in the year, we did see 2 periods of low standard deviation. And so just this is kind of to wrap it up. This is the tool that I then use. It has an input of standard deviation, but along with a lot of other pieces of data that I now use for my timing of volatility. And I call it my volatility risk trigger. And this will be, I'll be rolling out a way to subscribe to this probably the next couple of weeks as a service. But this is, I think there's a lot of different information that I think goes into the way to evaluate the volatility market. And one of them, as I wrote in my paper, being standard deviation. But by itself, I don't think is a good enough timing indicator. It can kind of tell you when you're in an environment for volatility to go higher, but it doesn't give you a precise enough trigger. Go ahead.
Okay, go ahead.
No, that was my point.
So, okay, so let me ask you, when you get these readings that tell you that there's a potential volatility event coming, as a money manager, RIA, do you hedge? Do you move more to cash? How do you become defensive? And do you, when you get these readings, believe in them enough to take some action with portfolios?
Sure. So working for an RIA, I have restrictions on what I can trade. So I'm not able to go into the options market or the futures market to express an opinion. So using kind of the tools that I've been given in my toolbox, so to speak, the first thing I'm probably going to start doing is getting more risk, decreasing the amount of risk in our portfolios. So I'm more concerned with beta than alpha in that sense, where I want to increase cash. So in January, this blue dot here was January. When we did see, and then since I began raising cash in some of our more aggressive portfolios, our more equity-focused portfolios. So I was sitting closer to around 15, 16, 17% cash when we had that big move higher, because I had an expectation that volatility would rise, and then able to capture, then kind of buy back in after we had that volatility event. But yeah, my first instance is to have risk management, use it as a risk management tool rather than a way to profit from the rise in volatility. But it's definitely a possibility, but it's not a tool I have.
Okay, and let me ask you, with what's happening now in VIX, even though volatility has come in dramatically in a few weeks, it seems to me that I don't think we're going to see 10 for a while again. Do you think we've entered a new regime? You showed some charts from past events. I think the 2007 level, normal volatility levels before the crash were more like between 15 and 20. So do you think that we're going to have higher volatility levels no matter what the direction is of the market, and the days of 9 and 10 readings might be over for quite some time?
I think probably so. I think a big part of it has to do with what the Fed's doing. Being that big of a player in the market, they're going to leave a big footprint. So when you've had all these years of, and we've still been able to have volatility with the Fed doing QE, but as they exit the market, and now we have kind of that artificial put being taken out, that it now allows the market, I think, to have much more volatility, because you now have a buyer that's left the market. And while they weren't buying equities, that still has an impact on the equity market. So I think now that you have the Fed unwinding, you have some more international banks discussing unwinding or at least slowing down some of their buying programs. I think that creates the catalyst to where we could have some more volatility. I don't think we're at the point where we're going to start going into a recessionary type period or anything like that, but I think it's definitely, their thumb's kind of been taken off the scale that's going to allow volatility events to be more prevalent.
Okay, and as a certified market technician, the fact that we held the 200-day on most of the indexes during that panic and have retraced, I don't know, 78.6, do you think there's going to be a retest before we see new highs, or that was it?
Yeah, so I wrote on my blog last week kind of what my expectations were and said, okay, we've held the 200-day moving average. That was obviously the softball entry point there with everyone pretty much was watching that. So that almost became a self-fulfilling type prophecy. Typically when you have markets that then rebound, you'll see it will retrace about half of the decline, which that would have taken us back to about the 50-day moving average, which we did. We did see some supply re-enter the market around that level. Well, we had a couple-day consolidation at the 50-day, right around, it was like, what, 2,700. And then we've now moved higher. The fact that we didn't see a retrace after hitting the 50% makes me think that we'll probably my expectation is that we'll see new highs before we see a retest. We didn't have the divergences. We didn't have the weakness going into the downturn to make me think that it was going to be a much more protracted decline. And so typically the anything over 10%, you're going to see a lack of participation at that high. Whereas this decline was more sentiment based. It was, you had too many people on one side of the teeter-totter, and that teeter-totter had to be kind of reset. Well, we had a 10% correction, kind of shook out some of the hands and reset the market. And now it seems like we are seeing kind of more risk on trading again. Technology is doing well, financials are doing well. The higher beta portions of the market, growth stocks are doing well, have all kind of come back. We're not seeing institutions starting to sell, trying to sell this rally. It seems like they're more like buying this rally, which makes me think that's probably going to be more sustainable than some people believe.
Great interview, Andrew. I want to thank you so much for your time and wish you continued success with your RIA and your writings. And
thank you very much.
Like it or not, Andrew, you're now my trading warrior brother. And
I'm glad to be included.
Yeah, and I learned some things about volatility. What's the best way besides your Twitter handle at Andrew Thrasher for people to follow you and possibly
yeah, my blog is probably the best place. Yeah, athrasher.com is where I put out a lot longer term than what you can fit into a tweet. So athrasher.com is where I put all my commentary.
Okay. Well, thanks again, Andrew. I'm glad I reached out and invited you. Maybe we could get back together some months down the line and see what things are setting up for you. Maybe 3,200 S&P. We could talk again.
Sounds good.
Thank you very much, Andrew Thrasher. You can follow him at Andrew Thrasher or go to his website. And volatility is a very important ingredient of what we do, and you can learn and educate and be aware. So that's a wrap up for us today, everybody. See everyone tomorrow. Good hunting the rest of the day. See you in the private chat. And above all, don't just count your pips, count your blessings. See everyone for investing.com Thursday. See you guys tomorrow. Adios. You're very welcome, Bob. You're welcome, Kareem. And thank you again, Andrew.